Financial news anchors often credit record market highs to a resilient consumer or strong corporate earnings. But the data suggests the current rally is less about economic health and more about the mechanics of a high-stakes game. Retail traders on platforms like Reddit regularly turn weekly options into 2,000% gains, posting results that look like a capitalism speedrun. While these individual wins look like a fringe sideshow, the aggregate volume of these trades has become a primary driver for the entire S&P 500. The stock market has moved away from its role as an economic barometer. It is now a fragile system of automated trades that continues to run regardless of the economic environment. The historical baseline for investing relied on human analysts who meticulously modeled cash flows to determine what a company was actually worth. That connection between corporate performance and stock price has effectively broken. Prices no longer respond to the traditional gravity of fundamental value. Michael Burry, famous for profiting from the 2008 housing collapse, recently closed his hedge fund because his value estimations no longer align with the market. The new driver is short-term volume. Currently, 63% of all S&P trading volume consists of options that expire on the same day they are purchased. In a traditional casino, a lost bet simply goes to the house. In the stock market, this specific type of high-frequency betting forces a change in how the entire financial system manages risk. The process begins when thousands of retail traders buy short-term call options, betting the market will continue to rise. For every option bought, an institutional dealer must take the other side. Unlike the traders, these dealers are not allowed to gamble on direction. They have to remain neutral. This shows a requirement called delta neutral. To balance the risk of selling options, dealers must buy the underlying stock. When retail orders flood in, the scale tips violently. Dealers must immediately buy massive actual stock to keep their books balanced. This forces institutional buying to happen automatically. Stock prices move higher not because a company improved, but because the dealers were forced to buy. This forced buying pushes the stock price higher, which then triggers a structural feedback loop. This is a negative gamma regime. The market stabilization mechanics fail. Instead of dampening volatility, dealer hedging accelerates it. Every time the price ticks up, dealers must buy exponentially more stock to stay neutral, pushing prices up further. The market begins to act as a self-reinforcing engine, driving its own momentum without any external economic input. And once this dealer-driven buying starts, a second layer of automated systems begins to detect the rally. These systems, known as Commodity Trading Advisors, or CTAs, are programmed to buy whenever they see a strong upward trend. CTAs do not analyze corporate health or global politics. They are designed to dump billions of dollars into the market purely because the momentum models tell them to. This creates a closed loop. Options dealers and algorithms bid against each other, driving prices up in a system that no longer requires human intervention. If this feedback loop is driving prices to artificial highs, the question is, who is the final buyer at the end of the chain? For most people, that buyer is their own retirement account. Today, 63% of all U.S. stock funds are held by passive indexers. This represents over $13 trillion of wealth that is managed automatically. Passive money operates on autopilot. It is programmed to buy the underlying stocks in an index regardless of price. It essentially absorbs the shares that the algorithmic casino has pumped to the top. Passive investors are often the final buyers of stocks that have been bid up by a chain of automated dealers and momentum-chasing algorithms. Financial media continues to focus on quarterly earnings reports because those stories are easy to tell. They rarely mention the internal mechanics of dealer hedging or automated feedback loops. The reality is that passive, long-term investments are now structurally linked to a loop of high-frequency options gambling. The most significant threats to the economy are often the quietest. They aren't the loud crashes, but the automated mathematical loops that have become a permanent part of the market's architecture.